Most people think a war makes investors rich because they guessed the war was coming. That is almost never how serious money is made. I have watched enough cycles to know that the people who build the largest fortunes during crisis periods are rarely the people who predicted the crisis itself. Very often they were too early, too dramatic, or too attached to their own story. The ones who really make money are the ones who understand what always comes next. That is the distinction that matters. Now, the average investor hears a title like the U.S. Iran war will make some investors rich and imagine something crude: buy oil, buy weapons, buy fear, wait for headlines, hope for the best. That is not how I think. A war does not create one trade. It creates a sequence. First comes the shock, then comes the liquidation, then comes the policy panic, then comes the repricing of whatever assets the market wrongly sold in the first wave because it could not yet separate what was structurally damaged from what was merely being thrown overboard to raise cash. That is where the serious money lives. And right now, I believe we are standing in that exact window. Not the clean recovery stage, not the obvious crisis stage, the stage in between where people are still looking at the smoke while the most important investors are already studying the exits, the rescue routes, the policy response, and the assets that will move hardest once the panic changes shape. That is the part I want you to understand, not because I enjoy war, not because I think crisis is romantic, because markets are cold and they do not reward outrage. They reward structure, they reward whoever understands which mechanism comes next and positions before the crowd can say the name of it out loud. The first thing you need to see clearly is that this is not just an oil story. If it were only an oil story, the answer would be simpler and less valuable. Hire crude, buy producers, collect the move, go home. But the best opportunities are almost never the first ones the crowd can name. The best opportunities usually appear where the first-order shock creates a second-order misunderstanding. That is exactly what I think is happening now. At first, the market priced an inflation shock that made sense. Oil rises, shipping risk rises, energy costs spread, food costs follow. The Federal Reserve looks trapped, long-duration assets look vulnerable, gold gets talked about, growth gets questioned, the whole thing begins as a classic fear map. Then something more important starts happening. Bond yields begin behaving differently. The market stops looking at the war and asking only what it means for inflation. It starts asking something harder. What if oil at these levels is so damaging to growth that recession becomes the dominant outcome? What if the inflation problem does not disappear, but the recession problem arrives faster and with more force than policymakers can tolerate? What if the real trade is not oil shock forever, but policy panic in response to what the oil shock is doing to the wider economy? That is a much more interesting question, because once the market starts shifting from inflation fear to recession fear, the leaderboard changes. That is the moment most investors miss. They stay trapped in the first headline, they keep buying what has already spiked, and they keep avoiding what is about to recover violently once the policy response begins to take shape. I have never thought that was intelligent. It is emotional lag dressed up as conviction. If oil rises into the zone where it begins destroying demand, confidence, and growth faster than it strengthens inflation psychology, then the policy conversation changes. The Federal Reserve does not need to love rate cuts for the market to begin pricing them. Governments do not need to solve the war permanently for the market to begin repricing the probability of de-escalation. Policymakers do not need to announce rescue measures in perfect language for institutions to begin moving into the assets that will benefit once some version of support arrives. That is the policy panic. It is not panic among households. It is panic among institutions and policymakers who suddenly realize they cannot allow the consequences of the first shock to continue flowing through the system without creating something even uglier. That is when you get the pivot, not always a rate cut at once. Sometimes something softer and more disguised: bond purchases, liquidity support, strategic petroleum releases, tariff relief, executive coordination, diplomatic signaling, allied interventions. A mix of actions designed not to solve the underlying problem fully, but to signal that the authorities will not sit still while the whole financial system reprices itself into a recessionary accident. That is the phase where fortunes are built, not because the world becomes safe, because the market suddenly has to reprice assets. It punished too much in the first shock. When I study crisis periods, I always separate assets into two buckets. The first bucket contains assets that are structurally impaired by the crisis itself. These deserve to fall because their economics are genuinely worse. Their costs rise directly, their demand weakens directly, their balance sheets become more fragile directly. If the war changes their real cash flow outlook, I have no interest in pretending otherwise. The second bucket contains assets that are temporarily repriced by panic. They are not broken, they are merely sold because investors need liquidity, because volatility is high, because sentiment is ugly, because the broad market is in liquidation mode, or because people are too frightened to distinguish between businesses whose economics changed and businesses whose price changed. That distinction is everything. If you do not separate those two buckets, you will do what the public always does in crisis. You will sell the things that matter, buy the things that already moved, and tell yourself you are being prudent. That is not prudence. That is surrender. The market is already showing us the map if you know how to read it. Oil is high. Yes, gold was hit hard in the liquidation. Yes, silver was hit even harder. Consumer sentiment is weak. Major indices have rolled over. Safe havens did not behave the way the average person expected in the first wave. That confuses people because they imagine crisis pricing as a clean moral story. Bad news should make defensive things rise and risky things fall in neat lines. Real liquidation does not work that way. In real liquidation, people sell what they can sell. They sell the liquid things. They sell what has profits. They sell what has bids. They sell what clears margin calls. They do not sell according to the purity of a thesis. They sell according to the urgency of cash need. That is why I do not get nervous merely because an asset associated with safety is down in the early phase of a crisis. Often that tells me more about who is under pressure than about whether the asset is long. Term case is broken. Gold is the obvious example. If the long-term case for gold were truly broken, I would care very much. But if gold is down because central banks, sovereign pools, and leveraged players are liquidating what they can to meet near-term cash demands, while the longer debt and currency logic remains very much alive, then I do not read the decline the way a retail investor reads it. I read it as forced selling. Forced selling is not the same thing as thesis failure. That is one of the most expensive lessons people learn too late. Silver is even more interesting because it is never just one thing. It is monetary history and industrial demand living inside the same metal. When fear and liquidation hit, silver often gets hit harder. Then, when the policy response begins to stabilize the market and the reflationary imagination returns, silver can outperform with a violence that makes late buyers believe they were early. They were not early. They were simply late to the second phase. This is where the sector logic becomes important. If you ask me where the richest opportunities usually hide after a shock like this, I start where the crowd is not looking correctly. Energy infrastructure is first. Not the producers that already spiked because every television panel can say their names. I am talking about the businesses that collect tolls on movement, storage, transmission, processing, and redirection pipelines. Terminals, LNG infrastructure, the assets that benefit when the world suddenly decides its supply routes need redundancy, its energy map needs rewiring, and its bottlenecks need workarounds that will still matter long after the first ceasefire headline fades. That is the sort of business I like. It benefits from upheaval without needing the commodity itself to remain at the panic price forever. It does not need oil at 115 every day to justify itself. It needs a world that now understands energy routing, storage, and transport resilience are worth more than they were before the war. That is a durable repricing. The next sector is defense and aerospace, but here again you must be more disciplined than the average person. The obvious winners often move first. The late crowd piles in and then wonders why its returns look worse than the story implied. I am less interested in chasing whatever already had its emotional move and more interested in the multi-year government spending channel that follows when an event changes national priorities for longer than the front page cycle. Wars do not just produce one quarter of spending. They reshape procurement, they reshape stockpiles, they reshape deterrence budgets, they reshape allied coordination, they reshape industrial planning. That is where deeper money gets made. Not in shouting about the first missile, in owning the businesses or the baskets that sit in the path of years of redirected state spending. Then we come to the part that most people find hardest to believe when fear is still high. Consumer discretionary. This is where discipline separates the adult investor from the child. When sentiment is broken, oil is high, and recession fear is growing, consumer discretionary becomes a hated sector because it seems obvious that households will suffer, and many will. But the market is not paying you for repeating what feels obvious. It pays you for recognizing when prices have moved to levels that already assume a degree of suffering more extreme than the likely policy path will permit. That is the key. If policymakers panic toward easing measures, if yields fall further, if oil comes off the boil even modestly. If escalation signals emerge, if the recession trade becomes the dominant framework, then beaten down consumer businesses with real franchises and survivable economics can reprice sharply from levels that reflect despair rather than realistic medium. Term cash flow. This does not mean you buy any retail name because it is down. That is not analysis. It means you recognize that the best gains after a panic often come from sectors that were priced for social collapse and then forced to live in the merely bad world that policymakers are trying desperately to engineer. The market is a machine for punishing absolute statements. Never forget that. Software is another area the crowd often mishandles in moments like this. If the market sells software because volatility is high and risk appetite is low, that is one thing if the economics of the businesses are actually impaired by the oil shock. That is another. Many software businesses do not care much about crude at 115 in the direct way airlines do. They care about capital markets, budgets, and sentiment. And if the policy response begins favoring lower long-term rates, easier financial conditions, and a renewed appetite for long-duration growth, software can recover much faster than the liquidation that hit it would have suggested. This is especially true if the underlying capital expenditure cycle in technology remains intact. That is why I keep coming back to the same principle. Separate structural impairment from temporary repricing. It sounds simple. It is not easy, but it is where wealth is made in a crisis. Financial companies tied to falling rates or easier conditions matter too, though one must be careful there because finance is always where hidden leverage lives. Consumer finance can benefit when rates normalize and credit conditions ease, but this is not a blind trade. It is a structural one. Who survives? Who has balance, sheet resilience? Who benefits from falling long-end yields? Who regains margin when the panic changes shape? These are questions, not slogans. That is how institutions think. And if you want the returns institutions get in crisis windows, you have to learn to think as they do. I have 3 rules in periods like this. First, do not chase what already had the obvious war move. If the crowd could name it on day 1, it is usually not where the biggest phase. Money will be made on day 30 or day 60. Oil producers, the most obvious weapons names, the first wave beneficiaries, those can be fine trades if you were early. They are much less interesting when the crowd arrives. The narrative is saturated, and the valuation already reflects panic demand. Second, follow the policy path, not the headline path. Headlines tell you what happened. Policy panic tells you what markets will price next. If the market begins moving from inflation fear to recession fear, then you have to understand that the eventual winners are not the same assets people bought in the first week of the war. They are the assets that benefit when governments and central banks begin cushioning, soothing, backstopping, or reopening channels that the initial shock knocked out of place. That is where the asymmetric opportunity appears. Third, remove leverage before trying to exploit anything. I cannot say this strongly enough. A correct thesis combined with the wrong capital structure is just another route to forced selling. If you are over-leveraged, the market does not care that you are right about what comes next. It only cares whether you can survive what comes before. And crisis windows are designed to punish people who require immediate vindication. The best investors in these periods do not merely think well, they are financed to wait. That is the overlooked edge. Now step back and see the whole sequence. The war creates the shock. The shock creates liquidation. The liquidation creates mispricing. The mispricing creates fear. The fear creates policy pressure. The policy pressure creates the pivot. The pivot creates the violent recovery in the assets that were sold too far in the first wave. That is the machine. Most people arrive after the pivot because they need emotional permission. By then, the easy money is already gone. I have never admired emotional permission in markets. It is one of the most expensive luxuries an investor can buy. History teaches the same lesson again and again. The investors who made extraordinary money after 1973 did not simply buy oil. The ones who made extraordinary money after 1979 did not merely admire the headlines. The ones who built huge fortunes after 2008 did not buy whatever was most frightening on television. They bought quality assets that had been repriced too far by a system forced into policy panic. That is the template. And I think the current moment fits it. The U.S.-Iran war will make some investors rich, not because war is good, because policy panic changes prices faster than most people can emotionally adjust, because de-escalation does not need to be perfect to create a violent repricing, because the Fed does not need to say, "We surrender," for the market to realize easier conditions are coming. Because the best assets to own after the first shock are often the ones that sentiment hit hardest without breaking their underlying cash logic, because the crowd always confuses what is loud with what is valuable, and because very few people know how to separate the thing that was truly damaged from the thing that was merely sold. That is why only some investors get rich in windows like this. Not because the information was secret, because the mechanism was uncomfortable, and uncomfortable mechanisms are where the best returns usually begin. If you want the sentence I would leave you with, it is this: do not waste your energy trying to be the person who predicted the war. Be the person who understands what the people in power will be forced to do after the war does its first round of damage. That is the more profitable role. That is the calmer role. And right now, I believe that role points clearly toward policy panic, a sharp everything bounce in the right beaten down assets, and a very expensive lesson for anyone who waited for the all clear before learning how the machine actually works. That is what I think this crisis will reward. Not the loudest fear, the clearest structure. There is another point I want to make because it sits at the center of why some investors do so well in periods like this while others merely survive them. The real money is rarely made in the first obvious move. The first move belongs to the narrative. The second move belongs to the mechanism. The narrative says war equals oil, oil equals inflation, inflation equals fear. That story is loud, emotionally satisfying, and usually crowded within days. The mechanism says something more subtle. If oil stays high long enough to damage growth, then the same shock that first looked inflationary begins creating a recessionary policy response. Once that realization takes hold, the market no longer rewards the assets that merely fit the original fear story. It begins rewarding the assets that are positioned for what policymakers will do to stop the fear from becoming systemic. That is a very different list. It is why I am so suspicious of investors who think being early to the headline is the same as being early to the money. The headline comes first. The money comes when the policy consequences of the headline are still being underestimated. That is what I believe is happening here. The war shocked the market. That part is over. The market is now being forced to ask the second question. What is the world of expensive oil, falling confidence, and growing recession fear force central banks and governments to do next? Once that question is asked seriously, the map changes. The panic trade becomes less attractive. The policy panic trade becomes more attractive. And that is the trade I care about. I also think people underestimate how violent the repricing can be once policy panic begins. Markets are not gentle when too much pessimism has been crammed into the wrong prices. A sector that was sold as though the consumer were dead can rally hard if energy comes off the boil and yields fall. A software basket that was dumped in broad liquidation can move very quickly if long-duration risk becomes more tolerable under easier financial conditions. Gold and silver can recover in a way that looks shocking only to the people who never understood why they fell in the first place. The speed is the point. Policy panic creates urgency because once the market senses that authorities are stepping toward support, no one wants to be the last person still sitting in the wrong story. That is why waiting for certainty is so expensive. Certainty arrives after the repricing starts. I have seen people spend their lives demanding proof that the turn is real before they act. They call that prudence. What it often is in practice is the purchase of emotional comfort at the expense of superior entry prices. They need someone in authority to bless what the market has already begun doing. By the time that blessing arrives, a very large share of the easy return is gone. You cannot make the sort of money Bank of America, as best clients are trying to make by waiting for emotional comfort. You make it by studying the mechanism and acting while the public is still trapped in the first wave explanation. There's also a more general lesson here that goes beyond this one conflict. Many of the richest crisis trades are built not on the event itself, but on the gap between what the event damages immediately and what policymakers will be forced to rescue afterward. That gap is where prices become irrational. It is where fear treats very different assets as though they were all equally guilty. That is why some of the best crisis investments always feel slightly strange when you first put them on. You are not buying what feels safe. You are buying what was misjudged. That is a much harder kind of courage, but it is the courage that tends to get paid. If I had to reduce the entire opportunity in front of us to one clean principle, it would be this. Do not ask what the war obviously helps. Ask what the war first crushes, that policy panic is most likely to revive. That is the sharper question. Energy infrastructure fits that principle because the world will not forget what this conflict taught it about choke points, alternative routes, storage, and transport resilience. Defense and aerospace fit because government priorities do not snap back to pre-war innocence the moment a ceasefire headline appears. Consumer discretionary at peak pessimism fits because the market is extraordinarily bad at pricing the difference between a frightened consumer today and a consumer the government and the central bank will try desperately to keep from collapsing tomorrow. Software fits because panic liquidation almost always throws long-duration growth into the same basket, regardless of which names are actually impaired and which are simply being marked down because people need cash, gold, and silver fit because forced liquidation is not the same thing as a dead thesis. And because a later policy response tends to revive the very monetary concerns the first liquidation temporarily buried. That is the whole board as I see it. Not one trade, a sequence of linked opportunities. And the investor who sees it as a sequence has a tremendous advantage over the investor who still thinks this is just about war. War is the spark policy, panic is the accelerant, mispricing is the fuel, the rebound is the result, that is the machine. And once you understand the machine, you stop feeling compelled to chase the first obvious move. You start thinking more like a patient allocator, more like a person who understands that real wealth is built by being right about what comes after the obvious thing everyone else is staring at. That is why I believe some investors will get rich here, not because they were lucky enough to guess the war, because they were disciplined enough to understand the structure. After the war did what all wars do in markets, create panic, confusion, liquidation, and then eventually a policy response that turns the whole first story upside down,